Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Trade management is where trading transitions from theory into reality. Entry decisions often receive the most attention, yet in professional trading, entry is only a small component of the overall outcome. What determines performance over time is how positions are managed once risk is deployed. Most traders approach trade management with a flawed objective. They attempt to maximize profit on each individual trade. This creates a tendency to micromanage positions, take profits too early, and hold losing trades too long. The result is a distorted risk-reward profile where losses are large and gains are inconsistent. Professional traders operate differently. They view trade management as a process of controlling distribution. The objective is not to maximize any single trade, but to ensure that across a series of trades, the payoff structure is asymmetric in their favor. This means small controlled losses and larger, less frequent gains. To achieve this, two core principles must be internalized. First, losses must be cut early and consistently. Second, winners must be allowed to develop without unnecessary interference. These principles sound simple, yet they conflict directly with natural human behavior. Cutting losses requires accepting that a trade idea is invalid. This challenges ego and creates discomfort. Letting winners run requires tolerating uncertainty and resisting the urge to lock in profit. This challenges emotional security. Trade management, therefore, is not just a technical skill, it is a behavioral discipline. The trader must override instinct and operate within a structured framework that enforces consistency. At an institutional level, trade management is predefined before the trade is executed. There is clarity on where the trade is invalid, how risk is controlled, and under what conditions profits are realized or protected. There is no improvisation once the trade is live. This is a critical distinction. Retail traders tend to decide what to do while the trade is active, reacting to price movements in real time. Professional traders decide in advance, then execute the plan with discipline. Understanding this distinction changes how trades are approached. The focus shifts from reacting to price to managing exposure. Every decision becomes a function of risk control rather than emotional response. The foundation of effective trade management is therefore clarity. Clarity on risk, clarity on structure, and clarity on behavior under different scenarios. Without this, consistency is impossible. To understand why most traders fail at trade management, it is necessary to examine the psychological forces at play. These forces operate subtly, yet they have a profound impact on decision making. When a trade moves into profit, the trader experiences a sense of relief. The initial uncertainty is reduced, and there is a natural desire to secure that profit. This leads to premature exits. The trader captures small gains, reinforcing the behavior, even though it damages long-term expectancy. When a trade moves against the trader, the opposite occurs. There is reluctance to accept the loss. The trader delays the exit, hoping the market will reverse. This leads to losses that exceed the original risk parameters. This asymmetry in behavior is known as loss aversion. Losses feel more painful than gains feel rewarding. As a result, traders unconsciously prioritize avoiding losses over maximizing gains. This creates a negative skew in performance. Professional trade management is designed to counteract this bias. Losses are defined and accepted upfront. There is no negotiation. Once the trade is invalidated, the exit is executed without hesitation. At the same time, profits are treated differently. Rather than being secured immediately, they are allowed to develop The trader accepts that unrealized profit will fluctuate. The focus is on capturing larger moves, not small, consistent gains. This requires a shift in mindset. The trader must become comfortable with giving back some profit in order to capture a larger move. This is counterintuitive, yet it is essential for positive expectancy. The key insight here is that trade management is not about being right, it is about structuring outcomes. A trader can be wrong frequently and still be profitable if losses are controlled and winners are allowed to run. This is why consistency in execution is critical. Each trade is part of a larger distribution. The outcome of any single trade is irrelevant. What matters is the aggregate result over time. Once this perspective is internalized, trade management becomes less emotional. Decisions are no longer driven by the outcome of the current trade, but by the requirements of the overall strategy. A structured approach to cutting losses begins with defining invalidation. Every trade idea is based on a specific premise. This premise must be clear before the trade is entered. Invalidation occurs when the premise is no longer valid. This is not subjective. It is based on specific conditions in the market. These conditions may be price levels, structural changes, or shifts in macro context. The stop loss is simply the execution of this invalidation. It is not a random level. It is the point at which the trade thesis is proven incorrect. This distinction is crucial. Many traders place stops based on arbitrary distances or risk percentages without linking them to the trade idea. This creates inconsistency. The stop becomes disconnected from the logic of the trade. Professional traders align stops with structure. They ask a simple question: at what point is this trade no longer valid? The stop is placed at that point, and risk is sized accordingly. Once the trade is active, the stop is not moved further away. Doing so would increase risk beyond the initial plan. This is a violation of discipline and undermines the entire risk framework. There are only two valid actions regarding a stop. It remains in place, or it is moved closer to reduce risk. It is never widened. Cutting losses early is not about avoiding pain. It is about preserving capital. Capital is the resource that allows the trader to continue operating. Without it, there is no opportunity to recover. This is why professional traders are highly disciplined in executing stops. There is no hesitation. The loss is accepted as part of the process. It is not viewed as a failure, but as a cost of doing business. Over time, this behavior creates stability. Losses remain small and predictable. This allows the trader to focus on capturing larger opportunities when they arise. Letting winners run requires a different set of skills. It is not simply about holding a position indefinitely. It is about managing profit in a way that maximizes the potential of the trade while controlling risk. The first challenge is psychological. As profit increases, the fear of losing that profit also increases. This creates pressure to exit the trade prematurely. To manage this, professional traders use structured approaches. One common method is scaling out. This involves taking partial profit at predefined levels while leaving a portion of the position open to capture further movement. This approach achieves two objectives. It locks in some profit, reducing psychological pressure while maintaining exposure to the trend. Another method is trailing stops. As the trade moves in favor, the stop is adjusted to protect profit. This allows the trade to continue while gradually reducing risk. The key is that these adjustments are planned in advance. They are not reactive. The trader knows under what conditions the stop will be moved and by how much. It is important to understand that letting winners run does not mean holding through all conditions. If the market structure changes or the original thesis weakens, the trade should be reassessed. However, this reassessment must be based on objective criteria, not emotional reaction. The trader must distinguish between normal fluctuations and meaningful changes in market behavior. The goal is to capture asymmetry. A small number of large winners should outweigh a larger number of small losses. This is the foundation of positive expectancy. Without this asymmetry, even a high win rate strategy can fail. This is why trade management is more important than entry. It determines the shape of the return distribution. Risk-reward dynamics are central to trade management. Every trade has a potential reward relative to its risk. This relationship defines the trade's contribution to overall performance. A common mistake is focusing on fixed risk-reward ratios. Traders aim for a specific ratio, such as 2-to-1 or 3-to-1, regardless of market conditions. This creates rigidity and ignores context. Professional traders approach risk-reward dynamically. They assess the potential of the trade based on market structure, volatility, and macro context. The expected reward is not fixed. It evolves as the trade develops. This means that trade management must also be flexible. If the market presents a strong trend, the trader may extend the target. If conditions weaken, the trade may be exited earlier. The key is alignment with the underlying conditions. Trade management is not a mechanical process. It is a structured yet adaptive decision-making framework. At the same time, risk must remain controlled. The initial risk defines the maximum loss. This does not change. What changes is how profit is managed. This creates an asymmetric profile. The downside is fixed and limited. The upside is variable and potentially large. This is the essence of professional trading. Over time, this asymmetry compounds. Large winners have a disproportionate impact on performance. They offset multiple small losses and drive overall profitability. This is why cutting winners short is so damaging. It removes the very component that generates edge. The trader may feel more consistent, but the long-term outcome deteriorates. Understanding this relationship is critical. Trade management is not about comfort. It is about optimizing the distribution of returns. Execution discipline is what connects theory to outcome. Without discipline, even the best trade management framework fails. Discipline begins with preparation. Before entering a trade, the trader defines the entry, the stop, and the management plan. This includes scenarios for different market conditions. Once the trade is active, the role of the trader is to execute this plan. There is no need for constant decision making. The structure has already been defined. This reduces cognitive load. The trader is not reacting to every price movement. Instead, they are following a predefined process. However, discipline is tested when the market behaves in unexpected ways. Volatility increases, price moves rapidly, and emotions intensify. This is where most traders deviate from their plan. Professional traders anticipate this. They design their framework to be robust under stress. They simplify decisions and remove ambiguity. For example, stop losses are placed in the market, not held mentally. This ensures execution even under pressure. Profit targets and trading rules are clearly defined. This level of structure creates consistency. The trader is not relying on willpower in the moment. They are relying on a system that enforces behavior. Over time, this consistency builds confidence. The trader trusts the process, even when individual trades result in losses. This is essential for long-term performance. Discipline, therefore, is not about being rigid. It is about being consistent within a structured framework. It is the bridge between strategy and outcome. Trade management must also account for market conditions. Different environments require different approaches. In trending markets, the priority is to capture extended moves. This means allowing trades to run and using trailing stops to protect profit. Exiting too early in these conditions significantly reduces potential returns. In ranging markets, the approach is different. Price moves are more limited and mean reverting. In this environment, taking profits earlier may be appropriate. This highlights the importance of context. Trade management is not one size fits all. It must be aligned with the prevailing regime. Professional traders constantly assess the environment. They adjust their management approach accordingly. This adaptability is a key component of edge. However, this does not mean abandoning structure. The framework remains consistent. What changes is the application within that framework. For example, the distance of trailing stops may vary based on volatility. Profit-taking levels may be adjusted based on expected range. The objective remains the same: maximize asymmetry while controlling risk. The method adapts to the environment. This requires experience and observation. The trader must develop an understanding of how different conditions impact price behavior. Over time, this becomes intuitive. The trader recognizes patterns and adjusts accordingly. This is where trade management evolves from mechanical execution to skilled decision making. Scaling is an advanced component of trade management. It involves adjusting position size during the life of a trade. There are two primary forms of scaling. Scaling out, which involves reducing position size as the trade moves in favor, and scaling in, which involves increasing position size as the trade confirms the thesis. Scaling out is more common. It reduces risk and locks in profit. It also helps manage psychological pressure as some profit is secured. Scaling in is more complex. It requires adding to a winning position without increasing overall risk excessively. This is typically done by adding smaller increments as the trade develops. The key to scaling is maintaining control of risk. The total exposure must remain within predefined limits. Each addition or reduction must be planned. Scaling should never be reactive. It is not about chasing price. It is about executing a structured plan based on predefined conditions. When done correctly, scaling enhances trade management. It allows the trader to optimize exposure and improve overall returns. However, it also introduces complexity. Without a clear framework, it can lead to overtrading and increased risk. This is why scaling is typically used by more experienced traders. It requires a strong foundation in risk management and discipline. One of the most important aspects of trade management is consistency. Inconsistent behavior destroys edge. If a trader cuts losses sometimes but not others, the distribution of returns becomes unpredictable. If they let winners run occasionally but take profit earlier other times, the asymmetry is lost. Consistency ensures that the strategy performs as expected over time. It allows the law of large numbers to work in the trader's favor. This requires clear rules. The trader must define how trades are managed and adhere to these rules consistently. At the same time, there must be room for adaptation. The market is dynamic. Rigid rules that ignore context can be limiting. The balance is achieved through structured flexibility. The framework defines the boundaries, and within those boundaries, the trader can adapt to conditions. This approach maintains consistency while allowing for variation. It is a hallmark of professional trading. Over time, consistent trade management leads to stable performance. The trader understands their distribution of returns and can make informed decisions about risk and allocation. Ultimately, trade management is about control. Control of risk, control of behavior, and control of outcomes over time. The trader cannot control the market. Price will move unpredictably. What can be controlled is how positions are managed in response to those movements. This is where edge is realized, not in predicting the market, but in structuring exposure. Cutting losses early ensures that no single trade has a disproportionate negative impact. Letting winners run ensures that profitable trades have the opportunity to contribute meaningfully. Together, these principles create asymmetry. This asymmetry is the foundation of profitability. Trade management, therefore, is not an optional skill. It is the core of trading performance. Without it, even the best strategies fail. The professional trader approaches trade management with clarity, discipline, and consistency. They understand that each trade is part of a larger process. By focusing on this process rather than individual outcomes, they create a stable and scalable approach to trading. This is the transition from amateur to professional, not in how trades are entered, but in how they are managed. There is a critical distinction between managing a trade and interfering with a trade. Most traders believe they are actively managing positions when, in reality, they are reacting emotionally to short-term price fluctuations. Interference typically manifests as frequent, unplanned adjustments, moving stops based on discomfort, closing positions due to temporary pullbacks, or taking profits simply because the trade has moved in favor. These actions feel justified in the moment, yet they are disconnected from the original trade logic. Professional trade management is intentional. Every adjustment has a defined reason that aligns with the initial thesis or evolving market conditions. There is no random decision making. Each action is part of a structured framework. To understand this properly, consider the life cycle of a trade. The trade begins with a hypothesis. That hypothesis defines both the opportunity and the risk. Once the trade is active, the role of the trader is not to second guess the hypothesis constantly, but to monitor whether it remains valid. Interference occurs when traders abandon this framework and instead focus on price movement itself. Price becomes the driver of decision making rather than the underlying logic of the trade. This creates instability. The trader is effectively chasing the market, reacting to noise rather than responding to meaningful information. Professional traders isolate signal from noise during trade management. They recognize that markets fluctuate continuously and that these fluctuations do not necessarily invalidate a trade. This is where patience becomes a skill. Allowing a trade to develop requires the ability to tolerate short-term volatility without reacting prematurely. However, patience must be structured. It is not passive. The trader is still engaged, still observing, but only acts when predefined conditions are met. This balance between patience and action is what separates disciplined trade management from reactive behavior. A key concept in advanced trade management is the distinction between realized and unrealized profit. Most traders treat unrealized profit as if it already belongs to them. This creates emotional attachment to the position. When a trade moves into profit, the trader begins to mentally account for that gain. It becomes part of their perceived equity. As a result, any pullback feels like a loss, even though no profit has actually been realized. This perception drives poor decision making. Traders exit positions prematurely to protect profit that was never secured. They prioritize emotional comfort over optimal trade outcomes. Professional traders view unrealized profit differently. It is not considered actual profit until it is realized. It is simply part of the trade's current state. This mindset reduces emotional attachment. The trader is less concerned with short-term fluctuations and more focused on the overall trajectory of the trade. This does not mean ignoring profit entirely. It means managing it objectively. Decisions are based on structure and conditions, not on the emotional impact of fluctuations. One practical application of this mindset is the use of break-even stops. Once a trade has moved sufficiently in favor, the stop may be adjusted to eliminate downside risk. However, this must be done carefully. Moving to break-even too early can result in trades being stopped out before they have the opportunity to develop. The timing of this adjustment should be based on market structure, not arbitrary profit levels. The trader must consider whether the trade has moved beyond the point of initial risk and into a more stable phase. Understanding the difference between realized and unrealized profit is essential. It allows the trader to manage positions without emotional distortion. Another important element of trade management is understanding volatility. Volatility defines the range within which price is expected to move. It directly impacts how trades should be managed. In high volatility environments, price swings are larger and more frequent. Stops must be wider to avoid being triggered by normal fluctuations. At the same time, potential rewards are also larger. In low volatility environments, price movements are more contained. Stops can be tighter, but the potential reward is also reduced. Many traders fail to adjust their trade management to volatility. They use fixed stop distances and fixed targets regardless of conditions. This creates inefficiency. Professional traders calibrate their management approach to volatility. They assess how much the market typically moves and adjust their risk parameters accordingly. This includes not only stop placement, but also trading strategies and profit-taking levels. Everything is aligned with the expected behavior of the market. Volatility also impacts position sizing. Larger volatility requires smaller position sizes to maintain consistent risk. Smaller volatility allows for larger positions. This integration between trade management and volatility is critical. It ensures that risk is controlled while allowing trades to develop appropriately. Ignoring volatility leads to either excessive stop-outs or insufficient reward capture. Both outcomes reduce performance. Trade duration is another dimension that influences management decisions. Not all trades are intended to be held for the same length of time. Short-term trades, such as intraday positions, require more active management. Price moves quickly, and decisions must be made within shorter time frames. Longer-term trades, such as swing or position trades, require a different approach. These trades are based on broader themes and require patience. The mistake many traders make is applying the same management style to all trades. They either overmanage longer-term trades or undermanage shorter-term ones. Professional traders align their management approach with the intended duration of the trade. This alignment ensures consistency and efficiency. For example, a short-term trade may have tighter stops and quicker profit taking. A longer-term trade may allow for wider fluctuations and use trailing stops to capture extended moves. The key is clarity. Before entering a trade, the trader must know what type of trade it is. This defines how it will be managed. Without this clarity, decision-making becomes inconsistent. The trader may exit a long-term trade prematurely or hold a short-term trade for too long. Trade duration is therefore not just a classification. It is a critical input into the trade management framework. Drawdown within a trade is an unavoidable reality. Even profitable trades often experience adverse movement before reaching their full potential. This creates a challenge for traders. They must distinguish between normal drawdown and a breakdown of the trade thesis. Normal drawdown is part of market behavior. Price rarely moves in a straight line. There are pullbacks, retracements, and periods of consolidation. A breakdown, on the other hand, occurs when the conditions supporting the trade no longer exist. This may involve a structural shift, a change in macro context, or a breach of key levels. The ability to differentiate between these scenarios is critical. Exiting during normal drawdown reduces potential gains. Holding during a breakdown increases losses. Professional traders rely on predefined criteria to make this distinction. They do not guess. They use structure, data, and context. This again highlights the importance of planning. The trader must define in advance what constitutes a valid pullback and what constitutes invalidation. By doing so, they remove ambiguity. Decisions are based on criteria, not on emotion. This approach allows trades to develop while ensuring that risk remains controlled. Another advanced concept in trade management is the idea of trade clustering. Trades do not exist in isolation. They are part of a broader portfolio. When multiple trades are open simultaneously, their interactions must be considered. Correlated positions can amplify risk. For example, being long multiple currency pairs that are all sensitive to the same macro driver effectively increases exposure to that driver. Professional traders manage trades at both the individual and portfolio level. They consider how each trade contributes to overall risk. This may involve reducing exposure in one trade when another similar trade is added. It may involve adjusting stops or profit targets to balance the portfolio. Trade management therefore extends beyond the individual position. It becomes a function of overall exposure. This is where portfolio thinking begins to integrate with trade management. The trader is no longer focused solely on individual outcomes, but on the combined effects of all positions. This perspective enhances risk control and improves overall performance. Emotional regulation is central to effective trade management. Even with a structured framework, emotions can influence execution. Fear, greed, and frustration all impact decision making. Fear leads to premature exits. Greed leads to overextension. Frustration leads to impulsive actions. Professional traders develop systems to manage these emotions. This may include predefined rules, checklists, or even stepping away from the screen during critical moments. The goal is to reduce the influence of emotion on decision making. This does not mean eliminating emotion, which is impossible. It means managing it. One effective approach is to separate decision making from execution. Decisions are made in a calm state before the trade is active. Execution follows those decisions without deviation. This reduces the impact of emotions during the trade. The trader is not making new decisions under pressure. They are following a plan. Over time, this creates stability. The trader becomes less reactive and more consistent. Trade journaling plays a critical role in refining trade management. Without feedback, improvement is difficult. A detailed journal captures not only the outcome of trades, but also how they were managed. This includes entry, exit, adjustments, and the reasoning behind each decision. By reviewing this data, traders can identify patterns. They may notice that they consistently exit winners too early or hold losers too long. These insights allow for targeted improvements. The trader can adjust their framework and test new approaches. Professional traders treat journaling as an essential part of their process. It is not optional. It is the mechanism through which performance is analyzed and improved. Over time, this creates a feedback loop. The trader refines their approach based on real data, leading to continuous improvement. Consistency in trade management leads to predictability in outcomes. This predictability is not about individual trades, but about the distribution of results. When a trader consistently cuts losses and lets winners run, the distribution becomes positively skewed. Losses are small and frequent, gains are larger and less frequent. This distribution is the foundation of profitability. It allows the trader to withstand losing streaks while still achieving positive returns. Inconsistent trade management disrupts this distribution. Losses become larger, gains become smaller, and the edge is eroded. This is why discipline is non-negotiable. It ensures that the strategy performs as intended. Trade management is ultimately about aligning behavior with edge. The trader may have a valid strategy, but without proper management, that strategy cannot realize its potential. Edge is not just about identifying opportunities, it is about capturing them effectively. This requires disciplined execution and structured management. By cutting losses early and letting winners run, the trader creates the conditions for edge to manifest. This is the essence of professional trading. Not prediction, but management. Not certainty, but structure. At the highest level, trade management becomes a process of continuous evaluation rather than static execution. The market is not fixed, and neither is the validity of a trade once it is open. What begins as a strong thesis can evolve, strengthen, weaken, or completely reverse depending on new information. Professional traders constantly reassess their positions, but importantly, they do so within a structured framework. This is not random re-evaluation driven by price noise. It is deliberate, based on meaningful developments. These developments can include shifts in macroeconomic data, changes in liquidity conditions, alterations in market sentiment, or structural breaks in price behavior. Each of these has the potential to impact the original thesis. The key is that reassessment does not automatically mean action, it means awareness. The trader updates their understanding of the trade environment and then determines whether the current position still aligns with that environment. If the thesis strengthens, the trader may maintain or even increase exposure within predefined limits. If the thesis weakens, the trader may reduce exposure or tighten risk parameters. If the thesis is invalidated, the trade is closed. This dynamic process ensures that trade management remains aligned with reality. It prevents the trader from becoming anchored to an outdated view. Anchoring is a common issue. Traders become attached to their initial idea and ignore new information that contradicts it. This leads to holding positions beyond their validity. Professional traders avoid this by maintaining flexibility. They are committed to the process, not to the trade itself. The trade is simply an expression of a view, and that view must evolve as new information emerges. Liquidity plays a significant role in how trades should be managed. Liquidity conditions determine how easily positions can be entered and exited without significant impact. In highly liquid markets, execution is smoother, stops are more reliable, and slippage is reduced. Trade management can be more precise. In less liquid conditions, price can move rapidly with limited volume. This increases the risk of slippage and gap moves. Stops may not be filled at expected levels. Professional traders account for this in their management approach. They may reduce position size in low liquidity environments or widen stops to accommodate potential volatility. They also pay attention to timing. Liquidity varies throughout the trading day. Certain periods, such as major market opens or economic releases, can create temporary spikes in volatility and changes in liquidity. Managing trades during these periods requires awareness. The trader must decide whether to hold through the event, reduce exposure, or exit entirely. These decisions are not made impulsively. They are part of the trade plan. The trader knows in advance how they will handle different liquidity scenarios. Ignoring liquidity leads to unexpected outcomes. Trades that appear well structured can fail due to execution issues rather than flawed analysis. This is why trade management must incorporate not just price and structure, but also the mechanics of the market itself. Another layer of sophistication in trade management is understanding the role of time decay in opportunity. Not all trades fail because they move against the trader. Some fail because they do not move at all. Capital tied up in a stagnant trade has an opportunity cost. While the position remains open, it prevents allocation to potentially better opportunities. Professional traders recognize this and incorporate time-based rules into their management framework. If a trade does not begin to move within a certain time frame, it may be closed or reduced. This does not mean exiting prematurely. It means evaluating whether the conditions that justified the trade are still present. Markets are dynamic, opportunities emerge and disappear. Holding on to a trade that is no longer aligned with current conditions is inefficient. Time-based management ensures that capital is allocated effectively. It keeps the trader focused on opportunities with the highest potential. This concept is often overlooked by retail traders who tend to focus only on price. However, time is an equally important dimension in trading. Trade management also involves understanding the interaction between conviction and flexibility. Conviction is necessary to hold positions through volatility. Without it, trades are exited too early. However, excessive conviction becomes rigidity. The trader refuses to adapt even when conditions change. This leads to holding losing trades and ignoring new information. Professional traders balance conviction with flexibility. They have confidence in their analysis, but they remain open to being wrong. This balance is achieved through structure. Conviction is applied within predefined risk parameters. Flexibility is applied through continuous reassessment. This prevents both extremes. The trader does not exit prematurely due to lack of confidence, nor do they hold blindly due to overconfidence. This balance is one of the most difficult aspects of trading. It requires both analytical skill and emotional control. Over time, it becomes a defining characteristic of professional behavior. Scene 25. The concept of trade expectancy is directly linked to trade management. Expectancy measures the average outcome of a trade over time, taking into account both wins and losses. Trade management determines both the size of wins and the size of losses. Therefore, it has a direct impact on expectancy. Even with a modest win rate, a trader can achieve positive expectancy if the average win is significantly larger than the average loss. Conversely, a high win rate can still result in negative expectancy if losses are too large relative to gains. This reinforces the importance of cutting losses and letting winners run. These principles shape the expectancy profile. Professional traders are constantly aware of this relationship. They evaluate their performance not just by win rate, but by the distribution of returns. Trade management is the tool through which this distribution is controlled. Automation and rules-based systems can enhance trade management. By defining rules in advance and, where possible, automating execution, traders can reduce emotional interference. This does not mean removing discretion entirely. It means using structure to support decision making. For example, stop losses and trailing mechanisms can be automated. This ensures that risk is managed consistently, even in volatile conditions. Alerts and predefined triggers can also be used to prompt action. This reduces the need for constant monitoring and helps maintain discipline. Professional traders often use a combination of manual and automated processes. The key is that the framework is clear and consistently applied. Automation is particularly useful in reducing the impact of emotional bias. It enforces discipline when it is most needed. Reviewing trade management performance is as important as executing it. Without review, mistakes are repeated and improvement is limited. Professional traders conduct regular reviews of their trades. They analyze not just the outcome, but the process. They ask specific questions. Was the stop placed correctly? Was the trade exited according to plan? Were adjustments justified? This level of analysis provides insight into behavior. It highlights areas where discipline may have broken down or where the framework needs refinement. Over time, this leads to incremental improvement. Trade management becomes more efficient, more consistent, and more aligned with edge. This process of review and refinement is continuous. Markets evolve, and so must the trader. Resilience is built through effective trade management. By controlling losses and allowing gains to develop, the trader creates a stable performance profile. This stability reduces the emotional impact of trading. Losing streaks are less damaging and winning streaks are more meaningful. Resilience allows the trader to remain consistent over time. It prevents overreaction to short-term results. This is critical for long-term success. Trading is not about individual trades, but about sustained performance. Trade management is the mechanism through which this sustainability is achieved. At an advanced level, trade management becomes intuitive. The trader develops a deep understanding of market behavior and how to respond to it. This intuition is not guesswork. It is the result of experience, structured learning, and continuous feedback. The trader recognizes patterns, understands context, and adjusts management accordingly. This allows for more nuanced decision making. However, even at this level, structure remains important. Intuition operates within a framework. It does not replace discipline. The combination of structure and intuition is what defines expertise in trade management. Trade management is the final layer of execution that determines whether a trading strategy succeeds or fails. It is where theory meets reality and where edge is either realized or lost. By consistently cutting losses and allowing winners to run, the trader creates an asymmetric return profile. This is the foundation of profitability. By integrating structure, discipline, and adaptability, trade management becomes a powerful tool. It transforms trading from a series of isolated decisions into a coherent process. This process is what enables long-term success. It allows the trader to navigate uncertainty, manage risk, and capture opportunity. Ultimately, trade management is not just a skill. It is a mindset. It reflects how the trader approaches risk, uncertainty, and decision-making. Mastering this mindset is what separates professionals from amateurs.